Hello, students. I know we are going through a very tough period of COVID and a very unusual thing of writing online. But just for your sake today, I have solutions for FAC 1502, the October-November 2017 question paper. I've prepared a slide, this slide that we're looking at of all the solutions for the question paper, starting from question 1 up to the last question. So question 1, if we go to question 1, it's all about bank reconciliation. So I've written a couple of points to note about bank reconciliation. That what is it all about is when you're reconciling, basically you're looking at the bank reconciliation from the bank side and also the bank reconciliation from the business side. So the business has a bank account in the ledger and also um, journals, which is the cash receipt journal and the cash payment journals. So these journals are combined, and posted into the bank account. See, cash receipt journal is posted on the debit side and cash payment journal is posted on the credit side. Yes, and then the bank has a bank statement. So the similar thing that you're doing in your bank account should be the similar thing that is in your bank account, in your ledger should be the similar thing that is going through in your bank account and in the bank statement. So meaning that when you debit your bank in your bank ledger, the corresponding entry that is done by the bank is crediting your bank account. So it is very essential to understand these principles um, before you even try to tackle a question paper regarding bank reconciliation. One other thing to note is, you understand that assets increase on the debit side and reduce on the credit side. Liabilities increase on the credit side and they reduce on the debit side, meaning that the bank regards you as a creditor. So when you deposit money into your bank, it's being posted on the credit side. But in your ledger, in your books, in your accounts, when you receive money from a client, when you have money in your books or a client pays you, you're going to debit, isn't it? When you deposit into the account, the bank is going to credit. Similarly, when you withdraw money into your bank account, either for paying wages or for personal use, um, in your ledger you're going to credit because it's a payment. So it's more like assets are reducing, so we're crediting. But since the bank regard you as a creditor, the moment you're taking money, the bank is going to debit you. As we say that um, liabilities increase on the credit side and they reduce on the debit side. So it's very, very crucial for you to understand that. In most cases, questions come with the word the bank statement has a balance of 400 unfavorable. So the moment you hear the word unfavorable in a bank statement, you note immediately that, oh, so that means it's a debit balance, isn't it? So when you're doing a bank reconciliation, when you start to say balance as per bank statement, you put it on the debit side, isn't it? If they say it's favorable, it means that the balance is on the credit side. It means that you have money in your account actually. So you put it on the credit side. And there are also other things to note here that are also highlighted. Refer to drawer checks. It means that in our common terms, it would mean that the check have bounced. Sorry for that. The check have bounced. It actually means that someone has paid you and you have cashed the check, and then the bank will tell you that that person doesn't have money in their account. So you have to go back to the person who gave you the check to tell them that your account doesn't have money at all. So when you receive a check, it's someone who is paying, right? So where do you put it? In your cash receipt journal, and then you deposit it in your account. It should be put on the credit side, of the bank's ledger. But now they won't put it there because the person doesn't have money, so they return the check to you. So what do you have to do? You have to cancel that receipt that you initially made, isn't it? So what do you have to do? You have to put it in your cash payment journal, isn't it? Cash payment journal. So all refer to drawers are put in your cash payment journal. A sell check. Banks have systems that if someone gives you a check, you should cash the check within 6 months. So it can be a case that you as a business, you've paid someone by check and they don't cash the check immediately. What do you have to do? um, the check will be regarded as stale when it's been kept and not cashed for a period of 6 months, isn't it? So the dates are very crucial when you're doing bank reconciliation. The date when the check is issued and the date when you're doing the bank reconciliation. Kindly note those are those are some of the crucial dates that you really have to note. So that would mean that the check is stale. You have paid, put it in your, when you pay, you put it in your cash payment journal, but now it's stale. You need to cancel it, isn't it? So how do you cancel it? You put it in a cash receipt journal, isn't it? And then there are also amounts that are obviously, so the idea of bank reconciliation is everything that is in your bank statement should reflect in your journals. So if there's something that is in your bank statement, it's not reflecting in your journals, like for example, bank charges, direct deposits, you take those amounts and you use them to update your journals. So it would actually mean that your journals were not completely recorded, or the recordings were not complete. So you need to go back now and look at, for example, the bank charges. You only see or determine the bank charges when you look at the bank statement. So you need to take those and put it in your cash payment journal. The direct deposits, you need to put them in your cash receipt journal, isn't it? So that's ideally, in a nutshell, what you need to look at when you look at the bank statement, isn't it? So we proceed to the actual solution. So according to the question, there were transactions that were there in the bank statement but were not there um, in the journals. For example, there were deposits made by Casing, Mr. Stolle, Kruger, and then the owner K Logger also deposited 10,000. So what do you do with these amounts? Basically, you put them in your cash receipt journal, isn't it? Cash receipt journal. And there were also other amounts, other checks that other amounts rather that were there in the bank statements, but were not there in our journals, were not recorded in our journals. These amounts were basically payments like to municipality, to insurers, rent for property, bank charges, and also interest on an overdraft. What do you do to those amounts? Those amounts, you record them where? You record them in your cash payment journal, isn't it? So after recording these, oh, there was also a stale check. If you look at the date, there was a stale check of 15,000, which was over 6 months from the date it was issued in November up to the date when we were doing our bank reconciliation. So that stale check, you put it in your cash receipt journal, isn't it? Right. So you totalize your cash receipt, you totalize your cash payment journal, and then you post them in your bank account. That's your ledger, right? In your bank account, that is in your general ledger. So your bank account has the balance at the beginning of the period. It's unfavorable, so it's going to be on the credit side, isn't it? It's going to be on the credit side. So your cash receipt journal total, you I mean, comes on the debit side, and then your cash payment journal total will come on the credit side. Then you balance. How do you balance of accounts? You look at the bigger side, and in this case, you can see that the bigger side is the credit side, right? Because if you add 40063 plus 220700, it will give you 260833, right? So you put this total in both sides, the credit side and the debit side. So for the debit side to equal the total there, you would say the total minus the amount in the CRJ, which is 20530 you get 55533, isn't it? So that's your balance carried to the next period or to the next month. That's the balance that you have to note, right? And then after that, you prepare a bank reconciliation statement. What do you start with? You start with bank as per balance as per bank statement. All right. So you are told that balance as per bank statement was unfavorable, so it should come on the debit side. Here, the 449970 is on the debit side. And you have outstanding deposits. Those are deposits that are reflecting in your journals, but they are not in your bank statement. So it can be a person has paid you cash and you are yet to deposit. So it's the end of the month and you haven't deposited that amount. So it's very crucial for us to do it, to look at all these amounts and include them in the bank reconciliation statement. Right. So there was an outstanding deposit of 65,000. We are including it on the credit side because this money is being deposited into the bank account, right? And then there were checks that were not yet presented. Those are checks that were written out, but they were not deposited, or they haven't been deposited into the bank account by the recipients of the checks. So we have check 456, we've check 460, we have check 467, we have check 436, and we have check 440. All right, so you add all these amounts. You put all these amounts in your bank reconciliation statement on the debit side, because these are payments, and we say when you pay, the bank actually debit your account. And then there was an error, a deposit that was made um, to the owner's personal account, but the bank actually posted it on the business account. So you need to cancel it. So it was deposited into the wrong account, which is our business account on the credit side. To cancel it, you need to put it on the debit side, isn't it? And then similarly, there was an error from the bank, of a check. They wrote a check for 70, as a different amount. So you look at the difference. So it was written as actually less than it was actually is. So what you have to do, you look at the difference, and the difference you need to put it on the debit side. Had this check been written as more by the 63, like for example, the bank would have recorded this check as more than we actually recorded it as. The difference will be on the credit side. So after doing that, you balance off your bank reconciliation statement. Look at the bigger side. So in this case, the bigger side is the debit side. So you totalize your debit side. After totalizing your debit side, you look at the difference between your debit side and your credit side, isn't it? So the difference should always be the same with what's in your bank account ledger, which is 55533. That will show you that you've totalized, you've gotten your marks, you have balance of the bank reconciliation statement. So this is bank reconciliations are free marks. They usually come between 20 to 33 marks. So it's crucial for you to totalize on that, because that will give you more confidence, as to how to tackle other subsequent. So we add all these amounts. We add all these amounts to determine whether we are making a profit or a loss. So we calculate all these, you get this amount, all right? And then you were told that there was interest that was still yet to be paid. So what do? You were told the loan is 150,000, interest rate is 10% per annum. So you just say 10% of 150,000, you get your 15,000 as finance cost. So if you want to determine all the expenses, you're going to say the total that you get here plus your finance cost, it will give you your 33,500. And so you say your gross profit minus the expenses, you get your loss, because your expenses are more than your income, isn't it? So we can proceed to the next. Should always be the figure here, should always be the carrying amount. So here the carrying amount is 113,500. How do you determine that? So you're saying costs of the asset less accumulated depreciation to get the carrying amount. You add the carrying amount of both the assets, and then you get this figure, right? And then from there you go to current assets. We have inventory. We are given our closing inventory that we calculated there, which was 84,000, and then we have trade and other receivables. Remember, in the trade and other receivables, we had that 3,000 credit loss that we included in our statement of comprehensive income. We need to deduct that, right? And we deduct that, we get 97,000, and we also have our bank account balance, which is 33,000, right? So from there we yes. So your bank account balance, you also edit them. Then you go to the equity and liability section, right? Since this is a sole proprietor, your equity is composed or comprises of capital. You have your opening capital minus the drawings. You add the deposit that was done by the owner into the bank account, and then you subtract the loss that we determined in the previous slide, which is your statement of comprehensive income, to get your 117,500, right? And you have your non-current liabilities. You do have your long-term loan. It's actually term, not 10. Long-term loan of 150,000 that was mentioned in the question paper. And then your current liabilities are your trade and other payables. So your trade and other payables, what do you have? You were told that my trade and other payables is 45,000, but you still have something that you didn't pay, which is the interest. So you also add the 15,000 that we calculated previously as finance cost, because it's a payable, to give you 60,000. So your total equity and liabilities should be the same with your total assets, isn't it? Which is 327,500, 327,500. So we can proceed to the other question, which was about PPE. Very interesting question. So your PPE question is a very easy question. We have main assets that we have: land and buildings, furniture, and motor vehicle, right? So the first thing, you were given some of the totals and some were not included. Is for you to calculate. If you look at my calc here, furniture, in my calc here for vehicles, these are very important calculations, right? You are looking at the first I calculated the cost of the furniture that was disposed. Um, so the cost was 75,000. The cost was given. I'm sure, yeah, yes, the cost was given as 75,000. The vehicle, how many? I mean, sorry, the furniture. How many years did we have it in our business? Is from the first time that it was bought up until the beginning of this current year. I calculated and I got 4 years, isn't it? In the current year, it was there for 7 months. All right. So if you calculate your depreciation for 4 years and then for 7 months, you get your total depreciation or your total accumulated depreciation for this asset, which is an addition 60 plus 87 gives you this figure, which is 87. I mean 68,750, isn't it? So it's very important for us to understand that the depreciation, each and every time you depreciate, it's increasing your accumulated depreciation, because the journal is debit depreciation, credit your accumulated depreciation account. So each and every time you're depreciating your accumulated depreciation and increasing, isn't it? And then I had to go and look what was bought during the year or any addition. We got an addition of 100,000, isn't it? So in a case that we're only given 75,000 and 100,000, how do we calculate maybe we're given this 725,000 and maybe the last figure 750,000, and we were told or we're required to determine the 75,000. How do you do that? It's always like the opening balance in terms of costs, right, plus what has been added, should give you the closing balance. But if you add 725 plus 100, it's not giving you 825 here. So automatically in your mind you should question that, oh, so there should be something that was disposed, right? So you would say the total 825 from the 750, it will give you 75. So you have different ways of calculating this, because always there is a relationship between at the beginning what's happening during the year and at the end of the year. So that correlationship actually makes you certain that the figures that you are getting at the end are correct figures, isn't it? So we have an addition of 100,000, but it's been in our business from when? From the date furniture number one was sold. So furniture number one was in the business for 7 months. So for this to be 12 months, so it's been here for 5 months. So you are calculating depreciation 20% of 100,000 for 5 months. You get that amount, isn't it? So that's your depreciation for the new furniture that was bought. Then you have depreciation of the furniture that has always been there from the beginning of the period up until the end of the period. It wasn't sold, it wasn't bought. How do you determine that? All right. You would say furniture, furniture at the beginning, which is 725, all right, minus what has been sold, which is 75,000. You get furniture that has been there in the business from the beginning up until the end of the year, which is 65,000, right? Which is 65,000. I always say this furniture, which has always been there in the business, is the easiest of all to calculate, right? And with this one, you just calculate depreciation of the 65,000, isn't it? Then you go to vehicles. Vehicles is the same concept. The explanation of vehicles was these vehicles were two vehicles. So basically the cost you need to divide by 2, the accumulated depreciation you divide by 2, so that you get the cost of one vehicle and the accumulated depreciation of the other vehicle. Since we're using um, a diminishing balance method, we need to calculate the carrying amount. So that's the whole purpose of this, to say costs were 470 minus accumulated depreciation, you get your carrying amount. Then the depreciation now is being calculated on these carrying amounts, isn't it? So that's how easy it is. The first thing that is a challenge, I guess, is to determine um, your carrying amount, and then from there you complete all these table. You complete all this table using the figures that are here, and then you create your motor vehicle account, which is the part B of the question, your accumulated depreciation account, your realization account. So basically those are T accounts. Assets are increasing on the debit, reducing on the credit. With the motor vehicle account, you have a balance of 940,000, and you had the motor vehicles that were bought for 520, these ones. So obviously you add, this is the bigger total, the bigger side, you add this side and that side. You put the total on both sides, like 146 or 1,460,000, 1,460,000 both sides. And there were vehicles that were sold. One of the vehicle was sold, or in actual fact it wasn't sold, it had an accident and it was scrapped. So basically scrapping, we use the same concept, scrapping and selling, or disposing, right? So this vehicle was worth 470,000. So you put the costs of the asset, isn't it? The cost, right? And then you determine your carrying amount, sorry, not carrying amount, your balance at the end of the period, which is a balance CD. All right. Then you go to accumulated depreciation. These figures, we calculated them here initially. So it's just blending these figures into your T account. Accumulated depreciation account is a contra of the asset account. So all the balances are on the credit side. So meaning that balance at the beginning of the period, which is this one, is the same balance which is that one. You put it on the credit side, and what you have depreciated during the year, which is the total of this depreciation, you put it on the debit side, and on the credit side. And then you totalize that, and then remember, the accumulated depreciation of the asset that was scrapped should be removed from the books, since this asset is no longer with us, and it's posted into the realization account. The purpose of the realization account is to determine whether the business has made profit or the business has made losses, isn't it? So we are removing this accumulated depreciation of this asset, which is basically, if you go here, we are looking at this figure. This figure is this figure that is, that we put there, isn't it? So we are basically posting that figure to say, no, this asset is no longer with us. We need to realize, or we need to determine whether we made a profit on it or not. Then the last thing is creating a realization account, where you put the cost of the asset, right, and the accumulated depreciation of the asset, and then what you have received. This vehicle was sold at a scrapyard for 8,000. This is what was received, and then from there you determine whether they've made a profit or a loss. If the credit side is less than the debit side, then it's a loss. If the credit side is more than the debit side, then it's a profit, isn't it? So, okay, thank you for participating in this. I hope you understood that this was a very easy question paper and it's very easy to pass. If you have any other question or if you have any question, join my YouTube channel. You can ask on my YouTube channel any question, and I can personally, um, respond or assist you in whatever way you want to be assisted in. I mean, with regards to this module. So I wish you all the best with your studies. I wish you all the best in the upcoming exams. Good day.